Stock of the day I picked, talking about having an ugly day. Collins Foods shares down 17% today on the back of a near 60% drop in half-year net profit. Company declaring fully franked dividend 12 cents a share. Company says margin pressure expected to remain for the balance of FY23. Of course, Collins Foods owns the KFC chain, Taco Bell. Scott, absolutely hammered today. KFC doing all right. Taco Bell disappointing. 16, almost 17% down in a day. Is this one of those companies that present a buying opportunity?
That's a really good question, Koshi. Very possibly. So let's kind of wind back a little bit. I got to say, mate, I think the Taco Bell experiment in Australia is a terrible idea. Now, I'm no fast food guru, so other people know more than me. They've tried it before. If you've had Taco Bell around the rest of the world, it's really, really low quality fast food. And realistically, some people would say that's an oxymoron, but even in the fast food world, there is just an absolute, tautology, I should have said. There's an absolute, so many better options around when it comes to fast food. But honestly, I think the experiment's silly. But the revenue problem isn't the issue for Collins. The issue is inflation and cost pressures. And they talked about that both before and now during the current year. And again, this is what I kind of alluded to before. Nobody should be surprised by this. If we're all tightening our belts, are fast food going to get a bigger share of the wallet? Probably, yeah, because we trade down from restaurants or something else. Domino's, I own shares in Domino's, will probably do okay. These guys will do okay revenue-wise. But if you look below that and say, hang on, if you're a relatively low-margin retailer, if you're selling products that have significant cost pressure, you're probably going to look at those. Remember, Macca's did that $1 menu not long ago. That's where you're going to go. So you're already probably trading down the average customer because they need to. But you've got massive cost pressures. You've got food cost pressures, wage cost pressures, energy, transport, all that kind of stuff. My point is probably just I'm surprised that people are surprised. You look at that and say, well, what else did you think was going to happen? Was Collins going to somehow be able to dodge this particular bullet? So to Mathan's point, they were probably too expensive to start with, quite honestly. We've looked at it a couple of times over the past few months and just gone, no, too hard at that price. So probably an overestimate of what they could achieve, I think, from many investors. And when the share price and the PEs are that high, you say, well, very probably the problem. So maybe the fall itself isn't the issue. Maybe where the price was previously. But again, you look at some of these falls and just think to yourself, I don't know what the market was otherwise expecting. It just seems crazy that this wouldn't have been the outcome for Collins in the event it was, in the event the market was surprised. And I guess as stock pickers, that is the opportunity, right? Sometimes just avoiding the stuff that's overpriced, other times trying to find value. Is it worth buying now? Look, I don't think so just yet. I think it's very reasonable that the shares are worth less in the environment. As I said, the market should have already known. But it's still what's probably 17-ish times earnings, depending on how this rolls out. And by the way, their outlook is for continued margin pressure. It's not cheap enough. It's come down.
Right.
Just because the stock falls doesn't mean it was great value if it wasn't good value before. It was overvalued before. Maybe it's just fairish value now. I think that's probably my best guess. Fairish is about the best I can say for it. But this is one the market got way too excited about. Did well avoiding it, but I think probably still want to leave on the sidelines for a while yet.
Okay. If you're in it, do you hold on or get out and look elsewhere?
Oh, you probably had some big losses. Here's the challenge for all this stuff, mate. I say this regularly when we talk about this thing.
Yeah.
If there are better options out, do I think it's going to fall dramatically from here? No, probably not. But again, I'm not making predictions. Do I think it's going to be one of the best 25 stocks in the ASX in the next 12 months? No. Yeah. So it is a really challenging one, right? If you want to maximize your returns, you got to find the best companies at the best prices. I don't think Collins fits that bill just now.
All right. Mathan?
Yeah, Collins Foods was one of the few that underperformed after it floated, and it struggled to in the first 6 months. I think they had a shocker with the Rugby World Cup. They blamed that people weren't eating KFC, and it underperformed. And usually after that, they tend to underperform for a long time. This one actually went against the trend and did really well. They bought a number of franchises. They've done really well. But geez, Scott's right. This is underperformed. It's in a downgrade cycle. You can see similar stocks. I mean, you think of things like Domino's and so forth, and you can see all the cost pressures that are coming through. So this is not really a shock. But the interesting part about it is one of the market darlings. Because it's done well, people are being trained by central banks to buy the dip. So every time something falls down, it goes, oh, this used to be a good stock, so I'll buy it. But the thing that you have to remember is everyone's looking at the last couple of years when every stock ran up on stimulus. So if you look at the share price, it actually ran up before the result, it actually surpassed pre-pandemic highs. So if you look at it over, let's say, 3-5 years, you'll see just before the pandemic crash, we actually went above that. So in reality, if you remove the last 2 years of delusionary pricing, the pre-peak multiple price was just over $10, and we ran past that. So you're pricing in a fair bit there. So I think once you got there, the risk was that it underperforms and gets hammered, and it's happened again. Is it cheap? I think Scott's bang on in the context that it's a good quality business in a bad macro cycle. Yes, are they good at executing? But it's going to be tough. So I don't think it's going to outperform too much. I think this thing will run into another selling around $10. So you're buying a 10-15% upside that's got a lot of macro risk working against it. So I think it struggles for the next 12 to 18 months. As good as management is, it's really tough. And if you're picking 20 stocks, this wouldn't be there.
Okay. All right. Marco wants to know,